Welcome back to the deep dive. Today, we are going to look at something that, well, it touches literally every single part of your life, whether you realize it or not.
It really does.
We're talking about the hidden machinery that keeps the Canadian economy moving. It's usually invisible.
Yeah, it's like the humming noise in the background of civilization.
Exactly.
Yeah.
We wake up, we swipe a card for coffee, we check a mortgage rate online, we hear a little snippet on the news about inflation targets. We move on.
Right. But underneath all of those daily interactions is this massive, sprawling machine.
It's huge.
It's a fascinating topic. And you're right, it's usually invisible to most of us. We see the price tag on a carton of milk, or we see a mortgage rate on a billboard. But we rarely stop to think about the massive, complex ecosystem that determines those numbers.
No, never.
It's a machine that determines whether a startup in Waterloo gets the cash to build a prototype, how a hospital in Saskatchewan gets funded, and frankly, whether your savings actually hold their value over time.
Exactly. It's not just about those stock tickers you see scrolling at the bottom of a news screen. It's about how a mortgage gets funded, how a startup gets the cash to build a prototype, and how the government pays for hospitals and roads.
It is the plumbing of our entire society, and usually you only notice plumbing when it leaks.
That is a great way to put it.
But today we're going to, tear up the floorboards and actually look at the pipes.
But to understand this plumbing, we are doing something a little different today. We're taking a deep dive into what is essentially the Bible for aspiring financial advisors in Canada.
Ah, the CSC.
We are looking at the Canadian Securities Course Volume 1.
A classic text. It's a dense text, I'll give it that. But the reason we're using it is that it strips away the marketing. It doesn't try to sell you a mutual fund. It explains the mechanics of how a mutual fund is built. It's the schematic for the Canadian economy.
It is. And I know what you're thinking, a textbook. Really. But here's the thing. While this book is designed to help people pass a licensing exam, it is actually this treasure trove of information on how the system actually works. It just gets down to the mechanics.
That's the real value of going to the source material, isn't it? It forces you to define terms that people toss around loosely. You hear monetary policy or Schedule I banks on the news, but do you actually know what those mean? This text defines them.
So that is our mission today. We are going to decode the jargon. We're going to map out the whole ecosystem, the players, the rules of the game, and the economic forces that really define wealth in Canada.
It's a bit like learning the rules of a sport. I mean, once you know them, the game becomes so much more interesting to watch.
I love that.
So consider this a crash course in financial literacy, but from the inside out.
Perfect. So here's our roadmap for the next hour. We are going to start with the landscape. The players, the banks, and the dealers.
And the firewalls between them.
Yes. Then we'll look at the rules. Who's the referee? And the unique, slightly messy way Canada regulates all this money.
After that.
Then we move to the economy, how we measure the engine itself. We'll cover things like GDP and inflation, that silent thief.
Okay.
Then the controls, how the Bank of Canada tries to steer the ship. And finally, the instruments specifically, that massive and I think misunderstood world of fixed income.
It's a comprehensive journey. Let's get into it.
Let's jump right in with part 1, the landscape. So the text starts with this really broad concept of capital. It's a word we hear constantly. Capital markets, raising capital. But what is it really? In this context, what are we actually talking about?
At its core, capital is just wealth. I mean, it can be real wealth, like, land and buildings, and can be representational wealth, like money, stocks, and bonds.
Okay.
But in the context of the market, capital has a specific job. Its job is to move. It needs to move from those who have it, the savers, the suppliers, to those who need it, the borrowers, the users.
So the entire financial system is just a mechanism for that movement.
That's it. The text defines it really simply as a mechanism to move capital from those who have it, the suppliers or savers, to those who need it, the users or borrowers.
So on one side, you have me putting money into my savings account or my RRSP.
Right.
I'm a supplier of capital.
Correct. You have excess capital, you're not using it right now. And on the other side, you have a company that wants to build a new factory or a government that wants to build a bridge. Maybe a mining company in Northern Ontario that needs to dig a new shaft.
They're the users.
They're the users. The financial system is just the mechanism to get your money to them efficiently and safely.
The text mentions 3 characteristics of capital, which I found really interesting: mobility, sensitivity, and scarcity. And the analogy they used was comparing capital to water.
It is a perfect analogy. Capital is like water. It flows, it is mobile, it can move across borders in a split second, especially in the digital age,
Right.
but it's also sensitive to its environment. Just as water flows downhill, capital flows where the conditions are favorable.
Favorable meaning what?
Yeah.
Safe. Profitable.
Both, exactly. It looks for political stability, reasonable taxes, rule of law, good investment opportunities. If a country or even a company becomes unstable or risky, capital just, it dries up.
It flows somewhere else.
It flows somewhere else, and that creates a drought for that country. And finally, it's scarce. There's only a limited amount of it, so everyone is competing for it.
So because it's scarce and mobile, we need intermediaries to help manage that flow. We can't just have people walking around with bags of cash looking for a factory to build.
No, that would be incredibly inefficient. And this is where the middlemen come in, the financial intermediaries. These are the institutions that facilitate the trading and movement of assets. And the biggest players here are the investment dealers and the banks.
Okay, let's break down the investment dealers first.
Yeah.
The text makes a really big distinction between two roles they play: principals and agents. This seems crucial to understanding how they make money.
Oh, it's fundamental. Think of it this way. When a dealer acts as an agent, they're like a real estate broker. They are matching a buyer and a seller. They don't own the house, they just facilitate the transaction. For that service, they charge a commission. It's relatively low risk for them.
So if I call my broker to buy 100 shares of Apple, they go find someone who's selling 100 shares, they make the swap, and they take a fee for doing it. They never actually own the Apple shares themselves.
Precisely. Now, contrast that with acting as a principal. When a dealer acts as a principal, they are buying the securities with their own money.
Oh, okay.
And putting them into their own inventory. They own it. They are taking on risk. They hope to sell it later at a higher price.
So that's like a car dealership buying a used car, putting it on the lot, and then hoping to sell it for a profit.
That's the perfect analogy. And their profit isn't a commission. It's the difference between what they bought it for and what they sold it for. In the industry, we call that the spread.
But if the price of that car or stock drops while they're holding it,
they lose money. It's their capital on the line. So when you see a firm acting as a principal, they are putting their own money at risk. This is often called underwriting when we're talking about new stocks or just proprietary trading in the secondary market.
Right. So principal implies risk. Agent implies service. That's a great way to think about it. Now, looking at the types of firms, the text lists retail, institutional, and integrated.
Yeah, and this is just about who their customers are. Retail firms serve individuals, you and me.
Okay.
And within retail, you have full service firms where you get advice and, hand holding, and you have self-directed or discount brokers where you're doing it yourself for a cheaper fee.
And I've noticed the rise of robo-advisors is mentioned in the text as well, which is a newer thing.
Yes, that's a huge trend. And it sort of sits somewhere in the middle, doesn't it?
Wow.
It uses algorithms to manage your portfolio based on your goals, usually for a lower fee than a human advisor, but with more guidance than a pure DIY account.
Right. Then you have the institutional firms.
These deal with the whale.
The big fish.
The big fish. Pension funds, mutual funds, insurance companies, they are trading massive volumes. They aren't dealing with $5,000 trades. They're dealing with $50 million trades. They aren't buying 50 shares. They're buying 50,000.
And finally, the integrated firms.
These are the giants. The big bank-owned dealers usually fall into this category. They do everything. They have a retail arm, an institutional arm. They underwrite new stocks. They trade bonds. They are the one-stop shops of the Canadian market.
Speaking of banks, let's talk about the actual banks. The text categorizes them into schedules, Schedule 1, 2, and 3. I'll be honest, I always thought a bank was a bank, but apparently the legal structure matters a lot.
It matters a great deal, especially for ownership and what they can do. Schedule IA banks are the domestic giants, the big six that we all know. RBC, TD, Scotiabank, BMO, CIBC, National Bank. The key feature here is that they are widely held.
Widely held, meaning no single person owns the whole thing.
Exactly. The rules state that no single person or group can control more than 20% of the voting shares. And this is designed to prevent a wealthy individual or corporation from treating a major Canadian bank as their personal piggy bank. They have to answer to a broad base of shareholders. It's a stability measure.
That makes a lot of sense for something so foundational to the economy. Then what is Schedule 2 and 3?
Schedule 2 banks are foreign-owned subsidiaries. So think of Amex Bank of Canada or UBS Bank Canada. They are incorporated in Canada, but they're owned by a foreign parent company. They usually focus on commercial or retail banking.
And Schedule 3.
Schedule 3 banks are foreign bank branches like Barclays or Citibank. They tend to focus very heavily on institutional finance and corporate lending rather than opening a branch on every street corner for you and me.
One thing the text really emphasized regarding banks is the concept of firewalls. This sounds dramatic, but it's actually a regulatory necessity, right?
Oh, it is. It's critical. Remember we said the big integrated firms do everything.
Yeah.
Well, that creates a lot of potential conflicts of interest. Imagine if a bank's lending department knew that a company was about to go bankrupt because they just missed a huge loan payment.
Right.
And they used that secret information to tell their investment arm to sell that company's stock before the public knew. That would be completely unfair and illegal.
So the firewall is a legal barrier preventing information from crossing between those departments.
Exactly. It blocks information flow. Your bank teller is not allowed to know the details of your investment portfolio with the brokerage arm, and the investment bankers can't share inside secrets with the traders. It's there to protect client privacy and market integrity.
Okay, we've got the players. Now let's look at the playing field, the markets. The text distinguishes between primary and secondary markets.
This is one of the most fundamental concepts. It's the difference between buying a new car and buying a used car.
Okay, I like that.
The primary market is where securities are created. This is the IPO, the initial public offering. When a company issues stock for the very first time, investors buy it, and that money goes directly to the company. That's capital formation.
Right, so if I buy stock in an IPO, my money is literally going to help build the factory.
Correct. But once that IPO is done, the stock starts trading on the secondary market, like the TSX. If you buy that stock a week later, you aren't paying the company anymore. You are paying the investor who bought it last week.
The company doesn't see a dime of that trade.
Not a dime.
So that's the used car analogy.
Mm-hmm.
I'm buying the car from the previous owner, not from Ford or Toyota.
Exactly. But the secondary market is still vital because it provides liquidity. I mean, nobody would buy in the primary market if they didn't think they could sell it later in the secondary market. You need an exit.
The text also breaks down markets by how they trade. Auction versus dealer markets.
Right. An auction market is what you picture when you think of the stock market. Buyers and sellers all come to one central place, like the Toronto Stock Exchange, and they compete. The highest bid meets the lowest ask, and a price is struck. It's public, it's transparent.
And dealer markets, what are those?
That's the over-the-counter market, or OTC. It's not a central building. It's a network of dealers connected by computer screens and phones. This is where most bonds trade.
So it's more of a negotiation.
It's a negotiated market. You call a dealer and you ask, what's your price on this bond? It's less visible to the public, but the volume is actually massive, much, much bigger than the stock market.
Before we leave the landscape, we have to mention the invisible plumbing. CDS clearing and depository services.
The unsung hero of the Canadian market.
It sounds like it.
When you buy a stock, money leaves your account and shares enter it. CDS is the central clearinghouse that ensures that actually happens. They net out all the millions of trades at the end of the day so that cash and securities swap hands correctly and efficiently. Without them, the entire system would grind to a halt.
Okay, let's unpack the next section, regulation and protection. The text calls it the safety nets. And right off the bat, there's this surprising fact. Canada has no federal securities regulator.
It is unique among major developed nations. The U.S. has the SEC. The U.K. has the FCA. We have 13 different provincial and territorial regulators.
That sounds like a nightmare for coordination. How does anything get done?
It can be, and that's why we have the CSA, the Canadian Securities Administrators. It's an umbrella organization where all the provincial regulators sit down and try to harmonize the rules.
So a company in Ontario doesn't have to follow a completely different set of rules than a company in British Columbia.
That's the goal. They created something called a passport system. Basically, if you are approved in your home province, let's say Ontario, the other provinces accept that approval automatically. It simulates a federal regulator without actually violating the Constitution.
And below the CSA, we have the SRO's self-regulatory organizations. This feels like the industry policing itself, which sounds risky.
To an extent, yes. but they're overseen by the provincial regulators. The government regulators delegate specific powers to these organizations. The big one is IROC, the Investment Industry Regulatory Organization of Canada.
Right.
They regulate the investment dealers and all the trading on the marketplaces. Then you have the MFDA, which specifically regulates mutual fund dealers. They're the ones setting proficiency standards, running the audits, and handing out fines.
The text highlights a very specific philosophy here. Principles-based regulation versus rules-based regulation.
Yeah.
What is the difference?
This is a great philosophical debate in finance. A rules-based approach is very prescriptive. It says, do not drive over 100 kilometers. It's black and white.
Okay.
If you drive 101, you broke the rule. If you drive 99 during a blizzard, you followed the rule, even if it was incredibly dangerous.
Okay, and principles-based.
Principles-based says, do not drive faster than is prudent. It puts the burden of judgment on you. If it's sunny and clear, 100 is fine. If it's a blizzard, 50 might be reckless.
So Canada favors that approach.
Generally, yes. It tells firms you must deal fairly, honestly, and in good faith with clients.
That sounds good, but isn't it much harder to enforce? I mean, fairly is subjective.
It is harder. It requires firms to have very robust compliance departments to interpret those principles. But the argument is that it's more flexible. Financial scammers are creative. They can always find loopholes in specific rules. It's much harder to find a loophole in the principle of don't rip people off.
Now let's talk about what happens when things go really wrong. Insolvency. The firm goes bust.
There are two main safety nets here, and it is crucial not to confuse them. First, for your bank deposits, you have CDIC, the Canada Deposit Insurance Corporation.
Right, this is the sticker you see on the bank door.
That's the one. It protects up to $100,000 per category if the bank fails. So your savings account, your RSP, your TFSA, if they were held in cash, or GICs at a member bank, they are covered separately up to $100 K each.
Ban for investment dealers.
Mm-hmm.
If my brokerage goes under.
That's CIPF, the Canadian Investor Protection Fund. It covers IROC members. The limit is higher. It's $1 million per account type. But, and this is a huge but, it only covers insolvency.
Right, let's be very clear on that. If I buy a risky stock and it goes to zero, CIPF doesn't write me a check.
Exactly. It protects you if the dealer goes bankrupt and your assets, your stocks and bonds, go missing. It does not protect you from bad investment decisions or market crashes. That risk is yours.
The final layer of protection here is the gatekeeper role. The KYC rule, know your client. I think a lot of people just see this as annoying paperwork when they open an account.
It feels like bureaucracy, but it is the absolute cornerstone of investor protection. The dealer must know your financial situation, your risk tolerance, and your investment goals. They are legally required to ensure that any recommendation they make is suitable for you based on that information.
So if I'm a retiree living on a fixed income and my advisor puts my whole life savings into some volatile crypto mining penny stock.
They have violated the KYC suitability rule big time.
And that gives me grounds for remediation.
Precisely. If that happens, you can go to arbitration or to the ombudsman, which is OBSI, to try to get your money back. But the KYC rule is also about anti-money laundering. They need to know you aren't a cartel boss trying to wash cash through the stock market.
Okay, let's zoom out. We've met the players, we know the rules. Now let's look at the game itself. Part 3, the economic engine. The text starts with GDP, gross domestic product.
The scorecard of the economy. It's the total market value of all final goods and services produced in a country in a year.
There is a formula in the text that everyone sort of learns in school and then forgets.
Yeah.
GDP equals C plus I plus G plus X, X minus M. Let's decode that quickly.
It's the expenditure approach, and it's pretty intuitive when you break it down. C is consumption. That's you buying groceries, haircuts, new phones. It's the biggest chunk of the economy.
Right.
I is investment. That's businesses buying machinery, software, building factories. G is government spending, roads, hospitals, military salaries. And X minus M is net exports. Exports minus imports. What we sell to the world minus what we buy from them.
Why do we have to subtract imports? That always confused me.
Because the C&I parts already include things we bought from other countries. If you buy a German car, that gets counted in consumption, but it didn't produce Canadian output, did it? So we have to subtract it back out to get an accurate picture of what Canada actually produced.
That makes sense.
Yeah.
The text also warns us about the illusion of growth caused by inflation, the difference between real and nominal GDP.
This is so critical. If GDP goes up by 5%, but prices also went up by 5%, did the economy actually grow?
No.
No, we just paid more for the same amount of stuff. That's nominal GDP. Real GDP strips out the inflation to tell us if we actually produced more goods and services, productivity producing more with less. That's the only way to truly raise the standard of living in the long run.
And that growth isn't a straight line. It's a wave, the business cycle.
Right. The economy breathes, it inhales and it exhales. You have the expansion, the economy is growing, jobs are being created. Then you have the peak. We hit the top, maybe things get too hot, inflation rises,
And
the contraction, the slowdown. If it lasts for 2 consecutive quarters, we officially call it a recession. Then you hit the trough, which is the bottom, and then you have the recovery where we start climbing back up again.
And investors are obsessed with predicting where we are in that cycle. The text lists different types of indicators to help with that.
Yes. You have leading indicators. These try to predict the future. The stock market is actually a leading indicator. It moves based on what people think will happen in 6 to 9 months. Housing starts are another one. If builders are starting new homes today, they expect buyers to be there 6 months from now.
Then you have coincident indicators.
Right. Those tell us what is happening right now, like GDP numbers or retail sales. And finally, lagging indicators confirm what has already happened.
The classic lagging indicator is unemployment, isn't it?
Exactly.
Yeah.
Companies are always hesitant to fire people when a slowdown starts, and they are just as hesitant to hire them back when a recovery begins. So unemployment often stays high even after the economy has already started to fix itself.
Speaking of unemployment, the text breaks this down into 4 types, and I found this really illuminating. Not all unemployment is the same.
No, it's not. And the difference is really important for policymakers. First, you have cyclical unemployment. That's tied to the business cycle. The economy is bad, so I lost my job. When the economy improves, I'll probably get it back.
Okay, that's the one we hear about most.
Then there's seasonal unemployment. You're a ski instructor in July. That's expected. It's not a sign of economic sickness. And frictional unemployment. This is just normal turnover. You quit one job to find a better one. You just graduated and you're looking for your first job. This is actually healthy. It means people are moving to better opportunities.
And the 4th one, the dangerous one.
Structural unemployment. This is the dangerous one. This is when there is a fundamental mismatch between the skills workers have and the skills the jobs need. Think of a factory closing down because the jobs were automated or moved overseas. Those workers can't just find another job if their skills are now obsolete. They need significant retraining. This type of unemployment can last a long time and is very painful for society.
The text also mentions the participation rate. Why is that number so important to watch?
Because the headline unemployment rate can be misleading. To be officially unemployed, you have to be actively looking for work.
Right.
If you get so discouraged that you give up looking, you drop out of the labor force, you aren't counted as unemployed anymore, the unemployment rate might actually drop, which looks good on the surface, but it's for a bad reason.
Because people just gave up.
They just gave up. The participation rate measures what percentage of the working age population is actually working or looking for work. If that number drops, it's a big warning sign.
Let's talk about the silent thief. Inflation.
Yeah, inflation is the steady erosion of purchasing power. $1 today buys less than $1 bought 10 years ago. We measure it with the CPI, the Consumer Price Index,
The basket of goods.
the famous basket of goods: milk, gas, rent, internet service. If the average price of that basket goes up, that's inflation.
And there is a historical relationship mentioned in the text called the Phillips curve.
Yes, the classic trade-off. Historically, when unemployment is very low, everyone has a job, they have money, spending is high, and that demand drives prices up, so inflation goes up.
And the reverse.
When unemployment is high, people have less money, spending drops, and inflation cools down. Central banks are constantly trying to balance this. They want high employment but low inflation. It's a very difficult tightrope to walk.
Which brings us perfectly to part 4, the control room. Who is walking that tightrope?
There are 2 groups with their hands on the controls: the government, which uses fiscal policy, and the Bank of Canada, which uses monetary policy.
Let's start with the government, fiscal policy.
This is the power of the purse. It's all about spending and taxation. If the economy is sluggish, the government can try to stimulate it. They can spend money on infrastructure, roads, bridges to create jobs, or they can cut taxes to put more money in people's pockets, hoping they'll spend it.
They're pumping gas into the engine.
Exactly. But if they spend more than they bring in with taxes, we get a deficit.
And to pay for that deficit, they have to borrow money by issuing bonds. This adds to the national debt.
Right. And the text warns about something called crowding out. If the government is borrowing billions and billions of dollars, they are soaking up the available capital in the market. That leaves less capital for businesses to borrow, or it makes it more expensive for them. The government effectively elbows private business out of the line for loans.
Now let's look at the other lever, monetary policy. This is the Bank of Canada.
The Bank of Canada has one primary job: keep inflation low, stable, and predictable. Their official target is a range of 1% to 3% inflation.
And their main tool to do this is the target overnight rate. This gets technical, so let's slow down. What is the overnight rate?
It's the interest rate that the major banks charge each other to lend money for one day, literally overnight.
Why do they need to lend each other money overnight?
Because at the end of every single business day, every bank needs to settle its accounts. Some will have a surplus of cash, some will be a little short. So Bank A lends its surplus to Bank B, which is short. The rate they charge for that one-day loan is the overnight rate.
Okay, so how does the Bank of Canada control a rate that's between private banks?
They set a target. Let's say they want the rate to be 2%. They then create an operating band around that target, usually 0.25% above and 0.25% below. So the band is 1.75% to 2.25%. Their goal is to keep the actual rate trading inside that narrow band.
And how do they force it to stay in there? They don't just ask nicely, I'm guessing.
No, they use what are called open market operations. They actively intervene in the market every day. If the rate is getting too high, meaning cash is too scarce in the system, the Bank of Canada initiates an SPRA.
A special purchase and resale agreement. Basically, the Bank of Canada lends money to the commercial banks. They buy T-bills from the banks with an agreement to sell them back the very next day. This injects cash into the system. More cash means the price of cash, the interest rate comes down.
And if the rate is too low, if there's too much cash sloshing around,
Then they do the opposite. An SRA, a sale and repurchase agreement. The Bank of Canada borrows money from the commercial banks. They sell T-bills to the banks. This sucks cash out of the banking system. Less cash available means the price of cash goes up.
so they are constantly injecting or draining liquidity to keep that rate exactly where they want it. It's like a constant fine-tuning.
Every single day. And because the bank's own cost of borrowing is based on this rate, it determines the prime rate they charge you and me for things like variable rate mortgages. If the overnight rate goes up, your mortgage rate goes up, it ripples through the whole economy.
But the text notes there are big challenges with this. Lags, for one. Yes, monetary policy is like steering a supertanker. If you turn the wheel today by raising rates, the economy might not actually start to turn for 12 to 18 months.
Wow.
It takes time for higher rates to discourage borrowing and spending and to eventually lower inflation. That's why central bankers have to be so forward-looking. If they wait until inflation is already high to act, they're already way behind.
And then there's the political cycle.
The eternal tension. Politicians operate on 4-year election cycles. They always have an incentive to spend money and cut taxes to get reelected. But the Bank of Canada needs to be the adult in the room who takes away the punch bowl just as the party is getting good to prevent inflation down the road. That independence from politics is absolutely crucial.
All right, we've arrived at our final section, Part 5, the instruments, specifically fixed income. The text says the bond market is actually bigger than the stock market.
By trading volume, yes, by a lot. It is absolutely massive. This is the debt market.
Why do companies issue debt in the first place? Why not just issue more stock?
The magic of leverage. Let's say a company has a project building a new factory that they're confident will earn a 10% return. If they can borrow money at 5% to build it, they get to keep that 5% difference as profit for the shareholders. It amplifies their returns.
The text clarifies the difference between a bond and a debenture. I thought they were the same thing.
Technically, they're not. A bond is secured by a specific physical asset. If a company issues a mortgage bond, it is backed by a specific building. If they default, the bondholders get the building.
Okay, there's collateral.
Exactly. A debenture is unsecured. It is backed only by the company's promise to pay and its general creditworthiness. There's no specific asset pledged.
But we call government debt government bonds.
We do, but technically they are debentures. You can't seize the Parliament buildings if the government defaults. But because the government has the power to tax, they are considered the safest investment there is, so everyone just calls them bonds out of convention.
Let's break down the anatomy of a bond. 3 key terms: face value, coupon, and maturity.
Very simple. Face value, or par value, is the amount you get back at the end. It's usually $1,000. Maturity is the deadline, the date you get that $1,000 back.
And the coupon.
The coupon is the interest payment you get along the way. Historically, bonds had actual physical coupons you'd clip off with scissors and take to the bank to get your cash. Now it's all electronic, but the name's stuck.
So if I buy a 5-year, $1,000 bond, with a 4% coupon.
You would pay $1,000 today. You get $40 a year in interest. That's the 4% for 5 years. And at the end of the 5 years, you get your original $1,000 back.
Simple enough.
Mm-hmm.
But here is where it gets tricky, and the text is very specific about this. The inverse relationship between price and yield. They move in opposite directions.
This is the single most important concept in fixed income. When interest rates in the economy rise, the prices of existing bonds fall. And when rates fall, the prices of existing bonds rise.
Let's unpack why, because it feels counterintuitive at first.
Okay. Imagine you have that bond we just talked about. You bought it yesterday. It pays 4%. Today, the Bank of Canada raises interest rates. Now, new bonds are being issued that pay 6%.
Okay.
Who wants to buy your old 4% bond when they can just go out and buy a brand new 6% bond?
Nobody. My bond looks terrible now.
Exactly. So if you want to sell your old bond, you have to put it on sale. You have to lower the price below $1,000 to a point where the total return, the yield, matches the new 6% reality for the new buyer.
And the other way.
Conversely, if rates drop to 2%, your old 4% bond is suddenly a gold mine. Everyone wants it. You can sell it for a premium for more than the $1,000 you paid for it.
That makes perfect sense. So if you hold the bond to maturity, you don't really care about these price changes day to day. But if you trade it, you are subject to interest rate risk.
That is precisely it.
And finally, ratings.
Not all borrowers are equal, right?
Yeah.
The Canadian government is considered AAA very, very unlikely to default, but a struggling startup might be rated a B or C. Bond rating agencies assess that risk.
And bonds with low ratings are called high yield.
Or, more bluntly, junk bonds. They have to pay a much higher coupon to entice investors to take on that higher risk of default. It's the classic risk-return trade-off in action.
We have covered a staggering amount of ground today. From the concept of capital as water, to the firewalls inside our banks, to the intricate plumbing of the overnight rate, and finally the mechanics of the bond market.
We've traced the journey of money. We've seen that the market isn't just a chaotic casino, as some people think. It's a highly structured, highly regulated system designed to do one thing: price risk and allocate capital to where it can be most useful.
But as we saw with the business cycle, it's not a machine that runs perfectly forever. It breathes, it has ups and downs, and those are often driven by very human emotions, fear and greed.
And that is the synthesis here, isn't it? The rules and the structures try to contain those human elements to prevent fraud with KYC, to prevent bank runs with CDIC, to smooth out inflation with interest rates. But ultimately, the economy is just the sum of all of our individual decisions.
Here's a final thought to chew on. We talk about principles-based regulation, where we rely on the judgment of individuals to do what is prudent, rather than just following a strict black-and-white rule book. In a financial world that is getting more complex every day, with robo-advisors, high-frequency trading, crypto assets entering the scene, does relying on judgment make our system more flexible and resilient? Or does it make it more fragile because it relies on people doing the right thing, even when no one is watching?
That is the billion-dollar question. As the machinery gets faster and more automated, the principles guiding the humans in charge have to work harder and harder to keep up.
Something to mull over until next time. Thanks for listening to The Deep Dive.
A pleasure. Stay curious.